Hi, I'm Ruban Selvanayagam from Property Solvers Auctions. In this video, I want to show you exactly how we value auction properties, and just as importantly, why so many agents, auction houses, and even some surveyors get it wrong. Auction valuation works very differently from estate agency valuation. Rather than offering a flattering number, experimenting with a high starting price, or relying on guesswork, the process has to be grounded in evidence and structured to generate real competition. At Property Solvers Auctions, we work from evidence, sold data, RICS quick sale valuation principles, refurb cost modelling, buyer psychology, and realistic timeframes. This is the part most sellers never get shown and why auction results can vary so dramatically between auction houses. Let's break it down properly because auction valuation is one of the most misunderstood parts of the selling process, and incorrect assumptions at this stage can derail the entire outcome. Unlike the approach used in most estate agency sales, auction valuation relies on precision rather than aspiration. Higher price points designed to test the market tend to backfire in an auction environment where momentum and buyer confidence are everything. Auction pricing is strategic. The aim is to spark interest quickly and create a competitive environment from the outset. Set the price too high and engagement drops away before inquiries even begin. Set it too low without a clear rationale and suspicion creeps in. Buyers start to wonder what's wrong. In the auction environment, decisions are driven by numbers, risk compliance, upgrade or refurbishment liabilities, and overall investment feasibility. Emotional dream home thinking rarely applies. Once the figure makes sense, commitment happens quickly. When they don't, interest shuts down just as fast. That's why valuation must begin with sold evidence rather than optimism. The starting point is the actual data. Land Registry sold prices, supported by accurate information on property size and land or garden extent. Without referencing real completed transaction and the physical scale of the asset, meaningful valuation simply isn't possible. Land Registry records remove the distortion created by asking prices, sold STC, under offer listings, and optimistic advertising. True comparables, condition adjustments, time adjustments, auction versus private treaty trends, and distressed sale patterns reveal what the market genuinely supports. This creates a factual baseline, something that many auction valuations overlook entirely. A significant proportion of overvaluations arises from relying on asking prices alone. Those figures rarely reflect what the market has and will actually pay. Once the sold price foundation is established, the next step is what we call a short period valuation logic. Auction conditions closely mirror the parameters recognised by the Royal Institute of Chartered Surveyors, or RICS assessments, such as full sale or quick sale value, 90-day or 60-day value, or the restricted marketing period value. These frameworks account for the need for certainty, reduced buyer pools, legal or structural questions, mortgageability limitations, and the typical decision patterns for time-sensitive purchasers. This is not an undervaluation, it's the correct methodology for an accelerated sales route. It also aligns with how experienced investors already assessed opportunities. Refurbishment costs form another essential component. This is an area where outdated assumptions can seriously distort valuation. Figures such as £15,000 for a full refurb or £500 per square metre belong to a previous market cycle. Many sellers are still being told you can refurbish a full house for £15,000 to £20,000, or that £500 per square metre is a sensible benchmark. These figures are years out of date. Industry sources such as the Building Cost Information Service, Office of National Statistics construction inflation data, and even the annual materials reports from suppliers like Travis Perkins all show substantial increases in labour and material costs since 2020. Labour inflation alone sits 25 to 40% in many traders, with some specialist contractors rising even further. And the reality on the ground, particularly when trying to secure reliable and decent contractors, is that the increases can be significantly higher. Material costs have risen, fuel and energy costs have risen, contractors are busier, projects take longer, and there's far more pricing uncertainty mid-project. Auction buyers factor all of this into their numbers, which directly affects how high they're willing to bid. A realistic valuation, therefore, requires a full refurb cost analysis, trade expectations, material inflation, contingencies, timelines, margin requirements, and sensitivity testing between cost and the end value. Understanding the likely buyer category is equally critical. Different buyer groups calculate value in different ways. Developers assess projects backwards from gross development value minus refurbishment and required margin. Landlords evaluate rental income alongside future upgrade obligations and regulatory pressures, including EPC compliance, the Renters' Rights Act, and lending shifts, and the broader market risks. Cash purchasers and traders emphasise certainty, liquidity, and the discount required for rapid completion alongside the resale potential. A valuation that doesn't reflect the expected bidder profile will almost always miss the mark. Only after analysing the data, the buyer type, and the real-world cost landscape can the pricing framework be established. This is done through three distinct values. First, the full market value, the level achievable through a standard private treaty sale, which these days is taking anything between 5 and 9 months, assuming all goes well. Then it's the auction value, the figure supported by competitive bidding within a fixed time frame. And then there's the underwritten value, the price point which committed investors are prepared to step in without hesitation. These three figures set realistic expectations, guide the reserve strategy, and shape any post-auction negotiation boundaries. Relying on a single valuation number is one of the fastest ways to misjudge the process. Where many auction valuations go wrong is straightforward. The risks are ignored. Common issues include comparing against superior properties, overlooking refurb inflation, mishandling mortgageability concerns, relying on asking prices, or guiding based on sentiment rather than evidence. When this happens, the outcome is predictable. Limited inquiries, weak bidding, and repeated relisting. The pricing strategy was flawed before the auction even began. When valuation is rooted in accurate sold data, correct risk methodology, realistic refurb cost modelling, genuine buyer behaviour, and structured price sensitivity, the result is clear and defensible pricing. This is what builds confidence amongst buyers, generates competition, prevents overpricing, avoids unnecessary discounts, and produces stronger hammer prices with low fall-through rates. Valuing a property for auction is both analytical and intuitive, equally an art and a science. It demands evidence, experience, and a clear understanding of how the market behaves when time pressure, risk, and opportunity converge. Get the valuation right, and most of the auction process falls naturally into place. Get it wrong, and everything becomes harder. Fewer inquiries, hesitant bidding, and compromised outcomes. If you're considering an auction sale and would like a valuation rooted in real data rather than guesswork, please email me at ruban@propertysolvers.co.uk, and we'd be delighted to compile one of our evidence-based auction valuation reports. A big thanks for watching.